right. Hopefully everyone got to learn a bit about privacy there and how we're approaching it, especially in institutional finance. And as we continue along today, we have another topic that's of interest largely because for a variety of reasons. Funds are being tokenized. Vaults are coming into this space as well. Some people may even say that vaults are the new funds. And really what we're talking about is asset management, right? How can we streamline operations? How can we talk about accessing new capital markets or new investor bases and the technology that surrounds it? Not to mention, of course, the asset management side of it and understanding the assets that things get deployed to. And of course, the best use cases for it. So with that, we will have where Onchain Asset Management is heading. Please welcome in Kathleen Wrynn from Invesco, Jasmine from Fidelity, Elizabeth Yenko from New York Life, and Isabelle Lee, who will be moderating from Bloomberg, and yours truly.
Is it on? Hi, everyone. It's a happy Wednesday, so let's all be more lively. We're here with a stellar panel. I'm Isabelle. I'm at Bloomberg News. I cover all the exciting things that we're going to talk about today, crypto, tokenization, blockchain, and all that, and traditional markets. So some of my colleagues like to call me TradFi reporter. But we're here to talk about how asset management is seeing tokenization. And again, we have a stellar panel. I'm going to ask one question, and I'm going to go down this line. So keep it short, and then we'll dig deeper into each of your expertise. So some years ago, tokenization was really just a pilot project, a pilot story, but now you're seeing it everywhere. Big asset managers are incorporating it, launching products. What's the biggest thing that changed in the last 12 months, in your view? Maybe we can start with you, Elizabeth.
Yeah, I think several things have changed over the last 12 months. First and foremost, there's the new administration that is acting as a tailwind to the industry, helping to set up guidelines for large institutions like ours. You have the technology really coming into its maturity, and I think just more demand, as people get used to using and dealing with digital assets. It's cheaper, better, faster in many different ways, and so I think all of those help to act as catalysts for this moment.
Lots of change there. Jasmine?
I will do a double click on the maturity, but what I will emphasize is rather than the technology maturity that people talk about a lot, I would talk about the issuers being more mature and also the users being more mature. When you think about maybe 2 years ago, when you see one new asset class has one product, you think that's a breakthrough event. But now you see there's a variety of different kind of products and serving the subsector of users with optimized features that shows the maturity of the industry. And also you see that users started asking questions under the hook. It's like, what does that token represent? Is it synthetic exposure of the underlying? Is it a true share living on chain? Is it digital twin? So you see that the users are getting a lot more sophisticated as well.
Yeah, I definitely agree with what they both said. Also looking back at the last 12 months, I say the Genius Act being passed was a big trigger because that's really, I think, allowed a lot of institutions be able to find product market fit for tokenized money market funds. So thinking of where we are today, the stablecoin market cap has really kind of remained pretty much unchanged for the last since October, around 300 billion. And so what we anticipate though with Genius Act becoming fully in place in the coming months is that's going to change a lot with more institutions now having the framework to launch their own stablecoins, and with that there's going to be more demand for tokenized money market funds. I think our view is to always, if you're going to tokenize a product, make it be a net better product than the traditional product that exists today. So either that's new utility or new product features, and that's what tokenized money market funds have really proven, and hopefully we'll see that across other asset classes going forward as well.
Basically my answer, so I'll just build off of that one. But yes, it's really understanding like, okay, you're essentially tokenizing cash, that's what stablecoins are doing, right? And then what backs them is those money market funds. So people, for a variety of reasons, finding reasons to tokenize cash, to have stablecoin issuances, whether it's white label or the sort, and having those money market funds that are Genius compliant as well, to be able to understand, like you said, the framework there, being able to then apply that and those learnings to other asset classes or investment strategies will evolve. And I think it's also opened up a lot of eyes into how people are approaching tokenization, whether it's partnering with a tokenization platform, building their own in-house and really owning the whole investor experience, and just opening eyes into what's gaining traction and also what best fits for that asset manager in particular.
So it seems like there's just really a lot of tailwinds for tokenization, from the legislation front to the maturity of investors. Kathleen, I want to ask you, because Invesco has been involved in digital asset products and tokenization. What are clients asking you right now? Do they want products that are just so happen to be on the blockchain, or do they want blockchain-focused products? What are you seeing on your end?
Yeah, it's a really interesting time they're in right now. We kind of see it in a two vertical approach. On the one hand side, we have a lot of traditional clients who want to gain digital asset exposure through crypto-linked products and traditional wrappers, most commonly crypto exchange-traded products. That's what we've been doing since 2019. Across Europe and the United States. But where we're hyper-focused now is tokenizing products, and that's where it's really kind of a new client to a large degree, and that's the Onchain native investor. And that's where it's working closely with them to better understand what type of exposure requirements they want, and also what are key use cases for utility to help us as we build out new tokenized offerings.
So you and Jason have made the point that money market funds and treasury products have gained traction. What's the next asset class in your view?
I think it's incredibly exciting how true greenfield it is right now. I think in the US, we're seeing a lot of exciting developments around tokenized securities. So again, thinking of tokenized ETPs is exciting what's possible there. Going back into fixed income, thinking maybe higher duration investment grade is also exciting. So I think really a lot of opportunities across the spectrum.
And Jasmine, Fidelity sits at the intersection of traditional asset management, but also digital assets. What's changed for you in the past year? Do you see investor demand, or institutional demand, or institutional comfort? Is there anything notable in your view?
I would say a little bit of both. Of course, Fidelity has been in the digital asset sector for a long time, since over 10 years ago. So we are closely connected with the Onchain native users as well. So of course that now we see the Onchain capital is getting a lot more sophisticated, as we say. They would demand more better solution in terms of asset allocation, and also the feature to be a lot more on par compared to what they used to have access to on the Onchain native environment. And on the other hand, which is quite new, is that I have many of the RIAs, broker-dealers, regional banks, trying to initiate conversation with us and say, hey, what should we learn about, right? Because you see that many of the large incumbents in our industry has pushing for capital market going on chain, which is quite exciting. So that I think even for the most traditional players, they want to get educated. They want to make sure that they can revisit their systems and compliance programs to get ready for kind of the future on-chain capital market world.
So when they ask what should we be learning about tokenization, what do you usually say?
I would say depending on who they are, right? So for some of the parties we talk to, they are quite familiar with the concept of getting on chain, right? They might have underlying clients holding Bitcoin. So in those cases, you would kind of get into the weeds of, hey, potential product opportunities, service offerings. But then many of the more conservative folks, then it's really kind of staying at the very high level. It's hey, what's the legal framework, and what are the latest news they see, and what does that translate to in their world, right? So anecdotally, one of the interesting conversation I had was a large investment manager that they had to accidentally deal with a token because one of their clients got an airdrop along with one of their investments. That really triggered kind of the urgency internally. In this case, they concluded to be hey, this is a very immaterial value, but maybe the next time they won't be able to do so, and they know that the clock is ticking. They really have to get ready.
And Elizabeth, you have a venture lens across the ecosystem. What's getting funded right now? What's attracting capital and what isn't?
AI is attracting most of the capital. But this is a space that, like, us at New York Life Ventures have been investing in for over a decade, since at least 2014, 2015. I wouldn't say we're heavily focused on it, but we certainly do have exposure. But right now, certainly anything that, at least for us, what is strategic to our company, applications across AI and the intersection with blockchain are super exciting. So that's where I would say, while AI takes a large portion of it, I think the next phase of that is AI and blockchain together.
In earnings calls, if you go through the transcript, almost everyone mentions AI. At least that's what we see on our end. So what trend in tokenized asset management gets a lot of founders excited, in your view, but leave maybe some institutional folks unconvinced? Is there something that pops into your mind?
A lot of the folks internally, especially within our organization, they've seen these cycles before. They've seen a lot of these market cycles before. So, I think they're certainly optimistic, but cautiously optimistic. They certainly don't go chasing after the next new thing. That's why we've been able to make it here for over 180 years.
I think on the cycles point, if I could just add to that, I think it's really interesting, thinking of the last crypto winter in 2022, at the time, a lot of enterprises engaged in really like private permissioned setups when it came to blockchain. That really gave several years to actually build kind of the tech stack to really be institutional grade. And now we're operating very much on public blockchains, right? It's a whole new world that we're in. I think with this current crypto winter, what we're seeing is this is kind of now that institutional grade evolution for decentralized finance, where that's where, for tokenized funds, again, thinking about how to create net utility, asset managers especially, we have to be more involved in terms of the risk management of things. I think that's where it's a lot of close collaboration with these protocols and partners that figure out how that balance looks like going forward.
Yeah, and there's also a lot of talks about building native on-chain portfolios, which is quite new as well, yeah.
Maybe to both of you, and then we'll get to Jason, who's been patiently sitting there. Many people assume that tokenization favors private markets, but what would you say is the advantage for registered security fund structures that actually makes those products on the blockchain more powerful?
Can you say the last part again?
Many people assume that private markets is what's good on the blockchain, but actually we also see registered fund structures on the blockchain, and I'm wondering what you think make those more powerful than if they weren't in a blockchain? Because that's a question, at least from editors in my newsroom. Why do I need a tokenized fund when I can just buy from my Fidelity or,
I would say I would not make it a binary question, answer of, hey, it has to be liquid, it has to be liquid, it has to be private, it has to be a registered investment securities that's available for everybody. It's really looking at single use case and whether or not that creates net new utility for that product, right? So is it solving an access issue? So many of the private investments, it's really solving the access point, right? Hey, lower minimum, and then potential international distribution. So that's what's the core goal of many of the private investments. But when you look at for example, tokenized treasury, right? It's a completely different use case and different set of new utility that gets unlocked, right? It's how to do better cash management on chain, or how to unlock collateral use case to make your collateral yield bearing brings capital efficiency, right? So these are different utility sets. So I would say, like years ago, people talk about, hey, like yes or no, should it be tokenized? Should it not be tokenized? I would say it's all about why it should be tokenized and also when it should be tokenized.
Completely agree. I think also just thinking of what format makes most sense and what are the key features wanted for that format. So thinking of our tokenized U.S. short Treasury fund and partnership with Superstate, it has features that those investors are interested in. Continuous NAV instant redemption. We're in registered format that could look differently for a different set of investors as well. So I think there's a lot of opportunities to tailor as see fit based on the underlying structure. When it comes to your private markets point, I think it's helpful to separate thinking of tokenized products as an investment. And then, what blockchain technology can also provide from a enterprise application efficiency perspective. So when it comes to private markets, I think there's a lot of opportunities even for private permission setups to really enhance kind of operations and also distribution across kind of known players in a more kind of closed-off environment using blockchain technology.
Those are excellent points, and I like the when and the why. Finally, to Jason, the gentleman in this panel. From the infrastructure side, where are you seeing actual adoption versus just experimentation?
From an infrastructure perspective, I think in the issuance side of things, there's just been more thought being put into where the compliance layer lives. I think that there's different approaches to it. Some people prefer to do it at the protocol level. Some people prefer to do it more so on like the platform, the tokenization engine or platform level. And so it's really understanding where you would prefer that. It also has to do with investor onboarding and their experience. And last but not least, of course, I think it's starting to have those conversations around legacy systems also connecting in when it's talking about reporting. Obviously, the transfer agent needs to be aware of who's holding what. The other portion, though, is we're also starting to have the more exploratory conversations on what else can you do with this asset, right? Like, you can tokenize a fund, you can tokenize an asset, but there should be a reason, one of two, or both, preferably. Either you're saving on costs and you're having operational efficiencies, or you're adding utilities such as being able to collateralize that asset, right? And so something for us that we're trying to do as an infrastructure as well is how can we power that? When you have long redemption periods for funds and you want to collateralize it on chain, it's kind of impossible in DeFi right now because you have that redemption window. So we figured, okay, well, let's just build something to essentially aggregate liquidity providers that can actually take on that for a haircut, of course. Make a spread on it, but also essentially what we're having is you're increasing the utility for the original borrower because they can collateralize the fund units that they have invested into. Liquidity providers are able to have exposure to that and make a spread if there is a bad debt situation or before that even happens. And the protocols and the curators don't have to experience that bad debt, which is something that obviously gets it off their hands and it allows for these assets to be listed a little bit faster.
And on tokenized funds, do you think that they should have their specific on-chain risk methodologies, or do you think that the way we look at traditional risk methodologies should just be ported over?
It's a blend. The way we've looked at ratings really through Cordora has been, yes, you rate the asset itself for what it is, its merits, right, and the probability of significant loss, but then you have more levers or parameters to account for when you have the blockchain involved, right? There's smart contract risk, there's the infrastructure that it's tokenized on. If you're talking about a vault, you have protocol and so forth, which April did not help with any of the confidence in DeFi. So it's really understanding what operational security metrics need to be considered and tracked and make visible for both for compliance departments to be a little bit more comfortable with it, but also for the actual security of what's being made available for investors, right? So.
I think this is a really important point as well. I participated in a operational risk industry roundtable yesterday, and it was interesting to hear kind of the variety of views on this. And I think that, you know, as an industry, we have to have more standardization and agreement on how this interoperability happens in a more seamless way. You know, is it baked into the token from a compliance perspective? Is there a compliance layer on top of the token? I think there's like a lot of early stage exciting opportunities, but at the same time, we need to come together with more standards and principles on how to make this more scalable.
So 5 years from now, question open to all, will investors know they're buying a tokenized fund, or will tokenization be the invisible infrastructure?
I think ideally it would just be invisible to them. What they're buying is a better product or a better service at the end of the day. And so, you know, when I buy an Apple phone or when I do things over the internet, and I'm not thinking about like what's happening inside the phone or, you know, behind the scenes on the network. I just know that I'm getting a better, faster service and experience. I don't know if it'll take 5 years or more, but I think that's the end goal.
I think it can be visible or invisible depending on the customer preference. I would say for some of the traditional users, you are used to a web page or even something that's more paper-based. That's fine too, right? But then if you look at the new generation of investors, maybe they prefer the UI UX that's wallet-based and they actually see the blockchain records of how their transaction get confirmed and settled instantaneously, then provide that.
I think as much as you can abstract away to get more mass adoption, kind of the wallet infrastructure and the getting on-chain friction that occurs is going to really help foster more conversions.
I was just going to say, I kind of agree it should be both, right? Just depends on the investor journey, right? There's a great transfer of wealth happening too, which means people have different appetites, different user experiences, right? You have a blockchain native person that has inherited and maybe want to allocate. So I'm bullish personally on vaults. I see them being as like a faster, cheaper way to deploy essentially a fund in a way that can redistribute, be able to reallocate. I think something I like to cite a lot is like Project Guardian, as from back in 2020, I want to say 3. But the idea that you can have cost savings and so forth just by having things tokenized, when you have private market assets that can be held in portfolios and hyper customized portfolios even. So again, it just depends on where the user base, the target user base is, and what makes them more comfortable, whether it's an on-chain product that they connect the wallet to, or just having it through their traditional brokerage accounts.
Let's talk about products and technology. So Kathleen, is there a product that comes to mind that became possible because it's on-chain and not just some traditional fund wrapped in new technology?
Interesting question. I don't know, maybe for my panels, if I get,
It just builds on the question that when people always ask, why do we even need it?
So I think
what can it do that the traditional?
Yeah, I think the real unlock that I think that now we're seeing, as mentioned earlier, around the intersection of AI and blockchain is I think that's really going to create. I think of Steve Jobs, back when the iPhone was first created, he gave us something that we didn't know we needed, and now we can't live without. Thinking of blockchain and AI, I think that's what tokenized offerings are going to do over time. I wouldn't say we're there yet. I think we're still early stages. I think it's been exciting, the evolutions and the creativity, not just in the US, but globally as well. I think how competitive things are being to help figure out and push the needle on what is possible. But I think that true innovation is still to be unlocked.
Jasmine, do you think that there's a category or an asset class that will just not be the best on-chain? A lot of people, at least, I like asking that, what asset class do you think will not work on-chain, or will not work best, because it may work, but not the best?
That's also an interesting question, because I think my answer will always be maybe it's not yes or no, whether or not it should be tokenized, it's about when, right? So when you look at just taking investment on-chain, that tokenization step, it's the easiest. There are two things that you usually think about. One is there an ecosystem on-chain, right, at the moment? If your assets gonna live on-chain on the island that you can't easily trade, can't cross collateral, can't really use it effectively, then it's not now, right? And then also the market backdrop, it's important too. At the end of the day, you're looking at the securities as an investment, right? So whether or not this is a good timing for this particular investment. So a perfect example is that when you look at tokenized treasury, the kind of explosion of growth came in the year of 2022, where we had the rate hike, right? All the on-chain capital was looking to get access to treasury yield because it makes sense for them, right? And then that drives these quick adoption. But until that timing, that's right. Maybe earlier, like you asked me 2020, then we will say not now, right, for a tokenized treasury.
When startups pitch, Elizabeth, tokenized asset management, where do they usually think values accrue? And for the incumbents, where do they think the value accrues?
For a lot of the startups, or at least the ones that we've seen, they pitch the operational efficiencies, which
the 24/7 instantaneous.
Right, the 24/7 instant settlement, those kinds of features. On the institutional side, we also believe that will be very valuable. We still have yet to see it in terms of data and evidence on a wider scale. So it's not to say that's not true. We actually believe that it's very true. I think we just need to part of the pushback to that argument would be, where else are we seeing this?
So obviously, most of the people here are bullish towards tokenization, but can you share some concerns you're hearing from the people you're talking to? What usually holds them back from going all in, and maybe your response to them?
Yeah, the privacy is a big one, just like we heard on the panel before. The other thing is, while regulations are being worked on, they are certainly not perfected at this point. And for a company like ours, an insurance company, we don't have the regulations in place, the insurance regulations in place to hold some of these assets. So that, I think, is the biggest thing holding us back.
Can I add one more point? So I think Jason was also alluded to, it's also the risk management guardrail, right? So when you look at tokenized security, it has a lot more than just the security itself. You are looking at things like smart contract risk and also cybersecurity risk when you're dealing with the on-chain environment, and also things like even like Oracle pricing issues, right? So there's a lot of these elements that I think market players need to make sure they have the appropriate risk management guardrail before they truly do something substantial.
Jason, what infrastructure challenge do you think needs to be fixed so that tokenization can really scale meaningfully?
Honestly, it's one that part of it is infrastructure, and part of it I think is just down to what's generally accepted. But I think identity, KYC, AML, specifically. Because when you can onboard someone traditionally, right, off chain, and then whitelist in, but it's not really scalable. Like if you can have a digital passport that has your information that can be transferred from one transfer agent to the other to register to understand who's holding what at any given time. Because at the end of the day, like tokenization, part of the thesis, right, is that like you're self-custodying, you're able to move fast in between assets and so forth. And so for you to have eligibility for an asset to be able to invest into something versus something that's not, like that has to grow. And part of the challenge is understanding, in the traditional world, even one asset manager A may not accept the KYC AML that asset manager B has done, even though they're both tier ones, right? But and so it's really understanding what are those needs, how do you transfer that information effectively, and so I think that's still something to be figured out. But personally, I think that is a bottleneck.
Question for the panel. We're at the midpoint of 2026. June 30 is the midpoint, not June 1, which is a common mistake. What's one thing that you think will exist in 2027 that doesn't today? It could be something concrete, or maybe a change that you hope to see. Yeah, I guess it could be a hope you wish to see, or something that you think will actually happen. Who's the brave soul that will go first?
I would like to see more traditional institutional capital move on chain. So when I said earlier, insurance companies like ours are currently not able to hold some of these assets, I would like to see that change. I think that bringing more capital on chain will really just help the positive network effects for the ecosystem.
But what will that change entail? Is it just open-mindedness, or is it legislation?
There is some, well, for us, it's regulation, and for others, I think there's an education element, possibly regulations, and they need to see the value of the better products and services.
I would say on-chain native portfolio for the asset managers.
Wow.
So I use this analogy that, so for asset managers, we're like a master chef. We create these portfolios in the investment fund format. So right now, we do these pre-made food, we cook it off-chain, and then we ship it on-chain, right? But until in the future, we have these ingredients living on-chain, then we'll cook it natively and then make it better. And then adding on the talks about AI and all these blockchain infrastructure, that there's really a lot of potential to create hyper-customizable portfolio at a much lower cost compared to today.
How will that look like in the supply chain, since we're continuing with a food analogy, is it just all in one restaurant, or do you see various people helping each other to have an on-chain yummy meal?
That's a good question. I would probably, we'll probably see different models. It's like, hey, you cook the meal, but maybe you can sell it at different places, right? It could be takeout food. It could be like kind of a,
Now I want lunch.
yeah, exactly, yeah.
I think to grow the size of the pie, there needs to be more collaboration, especially thinking like how can we make more secondary markets a reality. So yeah, I would definitely agree with that.
Yeah, on the note of collaboration, I think a lot of the announcements we see now, I think a year from now, we'll probably see some actual material things come to life. We see NYC, NASDAQ making their partnerships, a lot of traditional firms partnering with crypto firms or tech firms to bring things to market. You don't have to reinvent the technology if it's already been done, especially at a proven level. So then it's just truly integrating that to get it to scale.
Maybe directly on what both Jasmine and Jason said, it's really, how do we create more multi-asset offerings as well, whether it be through traditional wrappers or through on-chain digital native wrappers to help foster and grow that pie.
Another question for the panel. I love asking this. What's the most commonly repeated misconception when it comes to tokenization? I can go and you can repeat my answer. For me, it's fragmentation. That's what a lot of people always say because they're like, there's so many blockchains. I thought it is supposed to just unify everything. That's one common misconception I always, or misconception in the sense that it's a disadvantage that they're multi-chain.
I would say that's easy. I think like maybe the actual act of it, is one part, but also launching and managing a tokenized product, especially in traditional finance, requires dozens of groups be involved. And those dozens of groups are subject matter experts across usually one asset class and one jurisdiction. And as you look to grow different offerings, you need to then kind of increase the education and deep understanding on digital assets across other areas. So that would be my view.
I think another misconception is that by tokenizing an asset, it automatically makes it more liquid, and that is absolutely not the case.
Now I have to come up with a different answer. I think maybe I'll talk about the cost efficiency, right? So people talk about instantaneous, 24/7, and cost efficient. I would say, as of today, maybe that's not really the case. You really will really have to see much more substantial market adoption to get there.
I guess, well, I got to redo my answer as well. I guess the other one could be that you're holding it in your wallets. Like, yes, you can self-custody, but there's also something we said about having qualified custody and having off-exchange collateral and so forth that we've started seeing with some of the custodians out there. So understanding the technology and the infrastructure to really accommodate the needs of whoever that end user is. It's not always as simple as it seems.
Maybe this is for Kathleen and Jasmine. For large asset managers, how much transferability do they really want? And I'm also thinking about client relationship. Who now owns the client relationship?
Yeah, I'd argue right now it's very much important that it isn't permissioned, so we know who the underlying holders are currently as we get more comfortable operating in this space. I think over time that will likely evolve, as Earl mentioned earlier, kind of privacy enhancing capabilities to be able to move across more seamlessly open ways. But right now, really kind of having that secure risk management as we're newer engaging in this space is really critical.
I would say that's a super interesting question. I might have to think about it a little more because I hear people talk about now who control the wallet, control the client relationship. And then others think, oh, you still have to know that person instead of the wallet service provider that controls the customer relationship, right? So I don't think I'm gonna make a creative answer because I'll probably be wrong. Yeah, so I think this is something that we really all have to work through together to figure it out as an industry, right? You see that at least on the asset issuer side, there are different approaches, right? There's the partnership approach. You outsource to a party that handles that client interaction. You can get quicker to market. There are others that value the core client interaction, like they take the stand of building slowly, like in-house, right? You see that there are different approach, different flavors of moving assets on chain, and then eventually we'll see like which approach gains more like traction overall.
If we were having this conversation years from now, what do you think when we look back will make us say, oh, okay, tokenization has crossed mainstream? Is there a metric you're looking at? At least for us, when we write stories, we like to cite RWA, how there's like 20 plus billion and how it has grown 400% since last year. What is the metric you're going to keep an eye out for?
That's an interesting question. But I think one of the ways, maybe one of the more qualitative ways, is when the conversation is no longer around tokenization. And we're just simply now, again, talking about assets and products and services and what the features are and what the experience is like.
Yeah, say at the end of the day, being a fiduciary, we want to give clients the solutions they need, and that's where it's really much meeting them where they are. And so I think that's going to evolve a lot over time. And so what does that look like? I think us really being the key provider as part of that evolution, thinking of all the great evolutions that are taking place around things like the super apps and things like that. Like how does that infrastructure, how does that delivery change over time? Is something very interesting. I think every organization has their own kind of go-to-market strategy there, and like where do they want to play? And that's really where kind of being with our clients along the journey to support them.
Or when it becomes the default option.
Yeah. Jason,
I guess
passwords.
mainstream, I mean, I guess it would just be at the point where, kind of like what someone else mentioned, right? Like when people stop asking, like, oh, is this tokenized or whatever, it's just like it's available. If you care that it's on chain, great, you can ask, but the user experience has to be so fluid that you can just go ahead and embed. We see this already with like Coinbase, for example, the Earn program, right? Like it's in your app, you just click. It's very Web 2 experience, even though the back end is Web 3, right? It's a Morpho vault, right? So trying to do that for securities as well and getting there truly, I think it's just, again, having that user experience where people don't even know, but get to experience the benefits of blockchain. I think that's when we get to mainstream.
What do you think is the bigger constraint today? Is it lack of infrastructure or lack of investor demand?
For collateral?
For tokenization.
Sorry, repeat the question.
What is the bigger constraint towards crossing mainstream or getting to the next level? Is it the infrastructure or just the demand? You've made the point earlier, it's education.
I think it's a lot of things right now. I think it's liquidity, demand, understanding. I think we know this is going to happen. It's going to be a structural shift probably in how we operate over time. But right now it's early in evolution, and so really finding that demand and getting us comfortable, operating on chain in a sizable way is going to take time and be a journey.
Within your companies, how are they, maybe specifically for Jasmine and Kathleen, how are they thinking about this? Is this the next big thing for them? Like how much effort or resources are they pouring into it? And do they disentangle it with digital assets or is it lumped into one?
I would say for us specifically, we sit under the asset management business of Fidelity. So we pretty much handle anything that has an asset management angle and also deal with digital assets, right? So we manage, one way is like taking crypto assets in a traditional wrapper for access, and then or you take traditional assets on chain through tokenization. We kind of sit under one roof as the same business unit. However, when we see it, right? So how we see it is kind of 3 stages. We'll go through like hold and then use and build, right? So in the hold level, like that, in the hold stage, maybe things like a exchange traded product that makes sense, that goes first, get many of our users have exposure to cryptocurrency as an investment asset. And then in the use phase, it can be multiple flavors, it can be tokenized investment funds, it could be packaging on-chain yield in traditional wrappers. And then when you get to the build phase, that's really the convergence that will leverage what we've build, like what the elements that we have created in the hold phase as well as in the use phase to getting to the third phase, right? So I would say right now we don't segregate it just because naturally there's gonna be more synergy later on for having this broader mandate of digital assets and also the broader asset management mandate.
Yeah, we also organize it under digital assets. That being said, digital assets is one of our strategic priorities for the firm globally. And so thinking of this being a multi-year horizon evolution, similar to a multi-stage approach, thinking of building the core foundation, and then how do you scale that? And longer term, how do you fully embed it into all functions and regions?
We have around 1 minute left. Does anyone have any last words or points that they want to emphasize, underscore, double click? I learned that from Jasmine today. I've never used that double click on that point.
I would just say how exciting I think we are right now in terms of like where we are on the spectrum of institutional adoption. Thinking of some of the reports that have been published recently across financial services and the high projections, I think, for the amount of tokenized products are going to be tokenized by 2030, 2035 is very encouraging for the industry.
Personally, I think to really maximize the benefits, it comes down to like even originating an asset on chain, and everything else flows from there, right? Like if you have a private credit fund, but the loans are originated on chain, you can audit all that because the hashes are there. You can then build on the unit of the natively tokenized fund and use it as collateral. All of it is connected, but it starts from the very beginning, and then you can build from there and then rebalance portfolios more easily too, because it's all on chain and the underlyings are on chain as well.
Last words?
Yeah, we're super excited about the potential in this space and excited to keep exploring it.
Yeah, same for us. Very excited.
All right, thank you so much. We have Jason, Kathleen, Jasmine, Elizabeth. Let's give them a round of applause. Thank you for sharing your thoughts on the future of on-chain and asset management. It's really great. Thank you.
Thank you.